Hello, good day, New York. So, we're going to go over my theory of money. A little nice summary of the purpose of money, the value of money, the benefits of money, the downfalls of money, as well as the history of money and how money has played a role in society, in the past, in the present, and going into the future. So, in the beginning, money was always around as a way to barter, to exchange a product for another product or a service. That was the essential cause of money. Later, it developed to gold coins to represent value through their own value in how much gold and silver they're worth. Then symbolically represent value through banknotes and paper money. Then digital money, all the way up to cryptocurrencies and stocks and bonds and assets, fixed assets like property and land. So we had, but it's all barter, trading a good for a service. And then you had investment tools like interest, loans and debts, and then interest on those collections, those repayments. And that's how wealth increases. And of course, all the monetary supply on earth eventually leads to more inflation, because when the monetary supply goes up, the price of goods that people sell think they're worth more in value, so they go up as well. So the prices go up, that's inflation. So some prominent figures in money argued that, like, there was this guy Keynes who found out a very unique idea that taxation affects prices more than monetary supply. So the tax rate is going to affect the prices in the economy more than just how much you're printing money and the monetary supply would. I don't know if that's a true statement, but he's saying taxation affects prices more than the monetary supply. I don't know if that's true, but that's a hypothesis. Irving Fisher, or just Fisher, noted that there's a direct supply between monetary supply and prices. So he said the latter part. And Karl Marx, the Marxist, said the value of labor should result in the prices of goods rather than the demand for those goods. So like when COVID hits and they make these cheap masks and they sell them for $5, $10 a mask, that's the demand for the masks, whereas the value of the labor was much less to make those masks. Or when you spend a lot of labor to make something and there's no demand for it, so it loses its value and the workers don't get paid enough. Like the Amazon drivers driving the trucks, they're driving all day, 8 hours, and they get paid very low salary. Maybe they get paid good salary, some of them, I'm not sure. But warehouse workers, they get paid little money and they do a lot of grunt work, and they're not getting paid their fair value because the value of the goods is based on the demand. And also the prices and the wages are in this free market world where the corporation is seen as the goal and the worker is seen as the expense, the commodity, because you want to operate the most efficient business you can operate, the most efficient business machine, which means getting deals on resources, finding out a way to save costs, cutting costs of goods sold. Wages are like 50% of your expenses. So you're going to try to cut wages, and you're going to try and find innovation cheaply. And it's all about making sure the business is as efficient as possible rather than taking care of your employees. So that's why wages suffer. And then the government gives tax breaks to businesses. That's because it wants more thriving small businesses. But what happens is The people benefiting the most by an extraordinary exponential amount from tax breaks to businesses is the huge mega corporations, the monopolies, because the terms are the same. Small business pays 2% in tax. Starbucks pays 2% in tax. Small coffee shop pays 3% in donut tax. Amazon pays 3% in $3 trillion value tax. So the biggest corporations take advantage of these corporate tax breaks because they're the same for everybody. And the business is seen as the machine that should be well oiled rather than the worker. And I hypothesized, what if there was a way we could redistribute the value of this business that grows in the free market world without hindering free market competition? It's all well and good. You can start from zero and go to $10 trillion for your corporation. That's all well and fine, as long as you're not breaking any laws. But what if there was a way we could also share some of that wealth with maybe not just your workers, but with other citizens, with providing them with education and social safety nets like housing and healthcare and food, and just providing a better society for the most good of the citizen. So, and the way I came to that conclusion was through taxes. So we got to figure out a way to tax these huge corporations without influencing their competitive drive to cut costs and produce profits and revenue. And I came up with an idea, and I'll talk about it at the end. But let's go through some more history first. I'll get to that later. So some institutions you have are investment banks, brokerage, insurance, mortgage, credit, private and public funds, and equity. So these are all terms of investment, insurance, paying a premium and paying monthly deductibles, and then getting interest on top of that. Somebody makes money, somebody pays money, somebody gets insurance. Mergers and acquisitions, when a company conquers another company. There's regulation and antitrust laws for monopolies, but there's a lot of loopholes. And it's all governed by free market capitalism, meaning the competition sets the rules. If you do crappy products with too high prices, no one's going to buy your product. They're going to go to the guy next door. So you got to compete and outcompete the other guy for the most beneficial business. And then the government sets the taxes and the reserves and the monetary supplies by printing money in desperate times. Does public service, wages and unemployment, government bonds, so you can invest with the government. Government work like infrastructure and healthcare and that sort of stuff employed by the government, energy. There's accountability and media reports. And then there's exports, imports, and the tariffs they set when they're dealing with other nations for trade. One thing to note is when they print money in desperate times, it doesn't affect the economy that much. This has been historically shown. For example, like we just printed I don't know how many trillions, at least 4 trillion in 1 year, and then more trillions after that, to help the poor guys in the war and help with the COVID inflation for businesses that are suffering and people that are suffering during COVID. And look where the stock market is today. It's at record high. So when you print money, it caused some inflation. But in the past, like all the times they printed money, they did this historically. If it's in goodwill and the economy really needs it, it's in a recession, then printing money in the long run doesn't affect the economy that much. It actually helps it get out of a rut if done like responsibly. So there is some inflation, but I don't know how much that inflation is tied to the printing of money during COVID, whether it is for other factors. And I can't say what those other factors are. because the inflation is worldwide. Worldwide there's inflation. All the major governments. The cost of living has gone up. The cost of housing and land has gone up. It's just the times we live in. Can't say if it's all due to the printing of money, though. And then you have your personal finance, which is your budgeting and your expenses, your mortgages, your credits, your retirement savings, your portfolios, your personal investing accounts, your tax-free saving accounts, your registered accounts, your retirement savings. So they get interest and compound savings, and with a little bit of risk managed. And then you do your own budgeting and expenses based on your income and your outgoing costs. So that's a little bit of the role of money in our society. And the one thing I want to get to is this how companies are run and how free market world established the stock market. So companies rely on revenue. So they produce a good or a service, they sell it, that's their product, and they collect money. That's the revenue. That's how much money they get. But there's expenses to that. So how much it costs them to produce that good, to sell it, to manufacture it, to distribute it, to deliver it. And after all that, then they got to pay taxes, then they got to pay the research and development, and they got to pay their overhead costs, so their warehouse, their land tax, their rent properties, their office space, their office supplies, their business partners, their accountants and lawyers and HR department, and they got to pay all that to make the product. So after the revenue, that's called the top line. Then comes all those earnings, all those expenses, and they break it down like earnings after this expense, earnings after this expense, earnings after this expense. And when you get to the absolute bottom, that's the net income. And then that net income is in fact how much money the company generates. And the way companies stay afloat is oftentimes the net income is not that much. The net income is very small portion, like maybe 5% of the revenue. But when the revenue is like hundreds of billions, that 5% is still $10 billion. So it's still a good chunk of amount. And that's after you've paid your workers and paid the materials and paid for everything. So that's how much you're generating. But sometimes companies have bad years and they have negative net income. They lose money on the year, or they don't generate any money. And that's why they stay afloat through having a lot of revenue and then bragging about it and going on the stock market and getting investors to be owners of their company in exchange for cash. So they sell part of their company on the stock market saying, look how much revenue we can make. And if you invest with us, we'll eventually fix our net income. Or the other way they do it is through debt, which is cheaper and different, but more risky. I don't know. You can go through debt. So you can go to the bank and say, give me $100 billion and I'm going to pay you back $1 billion each year. And my company is going to be able to run. So that's how these big corporations work. They get $100 billion of debt, sometimes even more. Short-term debt, long-term debt. And they base it, they say we have equipment, we have construction equipment, we have land, we have intellectual property, we have inventory. So these are our assets, and we have subscribers. This is how much they're paying per year. So they have assets that they can say to the bank, this is why our company is gonna be, you're safe. You're gonna get your money back if we go bankrupt some way or the other. So that's how debt works. Now, for the stock market, investors, once your company sells part of its share, so say your company is like private, and then you say we're making this much revenue. So you say we're making like 10 billion in revenue. Okay, in 10 years, we'll make 100 billion in revenue. Or in 10 years, we'll make 250 billion in revenue. So they factor that in. They factor 10 years down the road. They factor that in. And then they say, so we're going to value our company, even though we're making like 10 billion in revenue today, and we're making like a few millions in net income, we're still going to value our company at $500 billion. And now pay us for this. It's $500 billion up to the public. However much you want to buy, you're buying that much of our stock. And now you are an owner. You get to make decisions. And you also, any more that our stock price share goes up, since you are owning it, you are getting money as well. So now you're an investor. So you invest in the stock goes up, the investor makes money. However, the stock and the company are separate. The company makes its money by selling to the investor. Once it's sold, that's it. It's done. The company can't get any more money. It goes through debt, or it goes to sell shares to the investor. After that is done. Once the stock market starts going up, that's no longer the company's property, because the company sold its property to the investor. So the investors own the stock. So when the stock goes up, the investors make money. When the stock goes down, the investors lose money. But the stock market going up or down, unless the company still owns part of their stock, doesn't affect how much money the company has. So the company can do poorly, they can do well, no matter what happens with the stock, their net income doesn't change because they've already gone through their financing by getting debt or selling to the investors at the beginning. And investors like abstract things. They don't just look at the net income. They say, you've discovered a new idea in like AI. It's not doing anything yet, but in the future it's going to be marvelous. So we're going to all invest in your company. It's going to go up 50%, 100%. Or look at all this your revenue grew, or your net income grew, but it didn't grow as much as analysts forecasted it to grow. So therefore the stock price is going to go down even though you hit record numbers, because we were expecting an even bigger record number. So investors like all these abstract things, and they're very not really reasonable. So the stock price never accurately represents how the company is. Maybe over the long run, but in the short term, a couple of years, it doesn't accurately represent what's going on. It's very reactionary and very overly sensitive. And it's a lot of these big guys, like big banks and big funds, that own the majority of the shares. So when they make a move, the market really moves because they have so much quantity of shares. It's not just me and you buying the shares. It's these banks and these hedge funds and these big investors, institutions that move the price of the stock up or down when they hear some news, when they see some reports, some statistics, some numbers. And the biggest one is revenue. So when revenue is good, more are going to invest. So that's how the stock market works. Now, so the company is incentivized to build itself, to outcompete others. Why? So it can gain a net income, so it can please its investors, so it can grow its stock price. But it doesn't have to pay that money to its workers. It doesn't pay any tax because corporate tax rates are so low in capitalism. That money stays in the hands of whatever the company is doing with it, maybe reinvesting into research and development or redistributing the profits up to shareholders. And then the stock market is remaining with a select few investors and funds. So all the money that this business creates, and sometimes it's a large business like Coca-Cola or Microsoft, that have been around for 50 years and are now worth trillions of dollars. And that money that it earned, like, what does it have to show for it? It didn't pay any tax. It's not paying its workers. It's got a few shareholders. And it's got some net income. And, like, that money is just not benefiting society. Nobody's getting better education. No one's getting better cost of living. No one's getting safety nets like food, healthcare, and rent. So I figured out the solution to this is a tax. But without hindering free market capitalism, because you still want to be able to grow a business from $0 to $10 trillion by smart decisions and outcompeting everybody, as long as you're not breaking any laws. So the ability to scale a business still generates a lot of money. I mean, you still generated somehow from nothing $10 trillion. So the ability to add $10 trillion to the economy, even if it's dead money and not helping anybody except for a select few, is still $10 trillion created. So a way to share some of that money for the good of the citizen and the nation, while not hindering its competitive efforts to thrive in the neo-capitalism world, is simply a tax, but on the stock market. Because if you tax the stock market, then it's the investors and the shareholders who need to pay a percentage of their tax, percentage of their profits. And it's not hindering the company, in fact. And because it's fair and equal to everybody, every company will be subject to this tax on their stock chart. So investors aren't going to be competing with one another for opportunities because the tax is the same for every company. And every company is unaffected because what happens to their stock price and their investors doesn't affect their net income or their revenue. That's separate from the stock chart. And why this would work is because the GDP, which is an astronomical number for the USA and China, is like 30 trillion each. And the federal budget, which comes from taxes for the USA, is 6 trillion. So the GDP represents all the trades that go on and all the monetary movements that happen, all the profits and trade that has gone on, and the work of the economy. So it represents the total output of the economy. It's 30 trillion in the USA. But the federal budget, which collects from property tax, income tax, sales tax, corporate tax, is 6 trillion. And there's always a deficit because they collect 4 trillion and they spend 6 trillion. Or they collect 6 trillion and they spend 9 trillion. So they collect maybe almost 50% less than how much they spend each year, which adds to a deficit and interest upon that borrowed money and whatever. But just alone, the S&P 500, which is the 500 biggest stocks in America, they total in market size, just the stocks. How much was it? Nearly 50 trillion. Only 500 companies. There's thousands of companies, hundreds of thousands of companies. Only the top 500 total 50 trillion. That's a large pool of money. So you could only tax such a small amount, 2% per year, just on the profits alone. So when the S&P dips and has a bad year, you don't tax it. You only tax the profits. 2% on the profits of 50 trillion, that adds 1 trillion per year to the budget, and it grows as the S&P grows each year. In 10 years, you're maybe adding $7 or $8 trillion to the federal budget just by taxing the stock market S&P 500. And the way it's done is when investors buy shares and sell shares, if they sell them for a profit on one of the 500 biggest companies, they only pay 2% fee that goes to tax. They're already paying bigger fees than that for their broker when they're making a big amount of money, institutions. Maybe not people like me who buy one share, but when you have an institution buying millions of shares and thousands of shares for hundreds of millions of dollars, they pay huge fees. So this tax would be nothing to them. But that tax equally applied to every profit on the S&P 500 would provide trillions of dollars to the federal budget. You could pay for free healthcare. You could pay for free education. You could do so much money with that. So much things with that money. You would just have to find out a way to place it by regulating it and find the correct system. Do you report it as a tax? Is it automatically taken based off trades? What happens when foreign investors invest? Who pays this tax? Do institutions get a break? Do personal investors through retirement savings get a break? What are the rules around it? So you'd have to figure that out. But you tax essentially the stock market at a small rate. Because it's the world's biggest economy, $50 trillion in the S&P 500. Only the USA can do this. No one else has that amount of money in their stock market. And that way, the stock is taxed. And the stock was helping nobody because it doesn't affect the company. You're not stealing money from the company. The company still gets to thrive and compete and set prices and get revenue and get net income and cut expenses and do everything it does just on a day-to-day basis. The investors pay a small tax, and that goes to the federal budget. The economy would then be incentivized to have a strong stock market because that's a source of revenue for the government. So you're incentivized to have a strong stock market. And that's that. You're relating the stock market to taxes to the corporation, because the corporation essentially grew to $3-4 trillion without paying any tax. They were paying 2 and 3% tax rates, which is what small businesses get. They took advantage of that as well. So they don't pay any tax. They don't pay their workers. They're only trying to maximize the business. And this way, to share some of that fairness is to impose a tax on the stock, which rises when the business does well. But it doesn't affect, in fact, the business. Is perfect. Perfect. Beautiful. So that was my theory on taxing the S&P 500. And my other theory is based on the Irving-Fisher equation. It's that if you were to print, based on this printing money, there's a sweet spot. If you print too little, it's bad. If you print too much inflation. But if you print just enough, the people are going to have more money to offset the amount of inflation that incurs. And it's based on this formula that the monetary supply and the demand and the prices of goods are factored in with the volume of transactions and the speed of transactions. So basically I came up like, if you give everybody $12,000 per year starting today, then the average citizen making less than $100,000 per year would be much more wealthier and be able to pay for the small inflation that happens based on the increased supply. because business is also making more transactions. So when more transactions happen, inflation stays down. So either inflation would not skyrocket because there would be more monetary flowing around and actually making trade happen, or people would just have more money to offset the prices of goods going up. But that would be more for the lower class citizens and not for upper businesses and stuff like that. So they would maybe suffer. But my theory is hopefully the inflation would be managed because this volume of transactions and the velocity of transactions would be increased due to this increase of monetary supply. Whereas when you're only giving everybody $1,000, that doesn't do anything. But if you give everybody 12,000, 10,000, then all the transactions start to increase, which controls the inflation. So you would have like infinite inflation and infinite wealth going up forever together, which is what already happens. But it would be a more wealthier economy for the citizen. So that was my theory of money from past, present, and very breakthrough futuristic ideas. Let me know what you think. Leave a comment, leave a like, leave a review, whatever. Share this video. To summarize, we got my theory of this inflation and printing money, taxing the stock market, your personal finances, your registered accounts, credits, savings, debts, insurance, interest payments, your institutions like banks and loans and insurance companies, your governments which collect taxes and provide services and print money and control recessions, the stock market and the businesses, the economy, how stock markets are not related to the company but the investors, how the companies report revenue, expenses, net income, earnings, profits. And then the very basic beginnings, bartering gold coins, silver coins, banknotes, digital currencies. And yeah, that's my theory of money. Cheers. Stay classy, New York. And see you in the distant future, LA.